This week, the market taught us something profound about human nature. When Trump threatened tariffs over Greenland on Monday, the Dow dropped over 1% in a single day. When he reversed course Wednesday, it surged back just as violently. The crowd reacted emotionally to political theater while missing the deeper structural story unfolding beneath the headlines. Most traders see this volatility as chaos. The stoic exploiter sees it as opportunity, because when humans behave predictably, markets become systematically exploitable. And this week revealed three critical patterns that separate disciplined capital from emotional capital. Here's what actually happened beneath the noise, why it creates specific advantages for those who think systematically, and how to position for what comes next without getting caught in the crowd's emotional swings. The human layer tells the real story. Tuesday's sell-off wasn't about Greenland economics. It was about uncertainty premium. The market had grown comfortable with elevated valuations, then suddenly faced unpredictable sovereign risk. Fear drove the selling, not fundamentals. Wednesday's reversal proved this. Relief rallies are psychological releases, not endorsements of improved conditions. The speed of recovery showed participants positioned for mean reversion rather than genuine reassessment. But here's the deeper pattern. Sector divergence revealed anchored bias masquerading as conviction. Tech stayed resilient while traditional sectors weakened. Intel collapsed 17% on guidance while Nvidia gained. This isn't rational analysis, it's narrative addiction. The market believes AI infrastructure creates policy-proof moats. History shows this thinking precedes major rotations. Meanwhile, transportation indices hit all-time highs while consumer sentiment languishes near recession levels. This bifurcation matters. Markets price the prosperity of high earners while ignoring erosion beneath. The system rewards those who recognize this asymmetric vulnerability. The system layer reveals the mechanical reality. Tuesday's decline and Wednesday's recovery showed identical magnitude, classic algorithmic rebalancing. When geopolitical catalysts reverse quickly, positioning unwinds drive price action more than fundamental repricing. The VIX spiked to 21, then collapsed to 16 within days. This binary response function shows volatility itself became a tradable sentiment indicator. Bond markets provided crucial context. 10-year yields held at 4.2% despite geopolitical de-escalation. This signals structural upward pressure from deficit concerns, not temporary risk premium. The Fed's hawkish pause removes the implicit put option that conditioned behavior for over a decade. Participants must now price risk without expecting liquidity intervention. Earnings season begins next week with mega-cap tech reporting. Microsoft, Meta, Tesla, and Apple will show whether AI spending delivers returns or just burns cash. The market priced perfection into these names. Any deviation from consensus triggers repricing, not because of external factors, but because of internal positioning structure. The Stoic approach is straightforward: distinguish signal from noise. This week's volatility was noise. Indices declined modestly despite intraday swings exceeding 2%. This is consolidation within uptrend, not correction beginning. The system absorbed geopolitical shock and repriced it within 48 hours. Those who sold Tuesday's low and bought Wednesday's high paid the volatility tax. Those who held position paid nothing. The divergence between price action and fundamentals creates opportunity for the disciplined. Transportation strength, while consumer sentiment stays weak, shows economic activity continues regardless of psychology. Sentiment lags price, it doesn't lead value. The market's efficiency in punishing Intel while rewarding Nvidia demonstrates capital reallocation from execution failure to execution success. This is not momentum chasing, it's the system's mechanism for rewarding adaptation. Second-level thinking means recognizing what this structure implies. The Fed's hawkish stance removes safety nets, forcing fundamental evaluation over policy expectations. Markets that price risk without central bank intervention are healthier than those dependent on it. The removal of put options increases short-term volatility but reduces systemic fragility. Next week's earnings will either validate current valuations or expose them as extended. There's no middle ground. The market has positioned for perfection in mega-cap tech. The structure indicates volatility will persist, sector rotation will accelerate, and execution will matter more than narrative. This isn't prediction, it's observation of what already exists. The crowd reacts emotionally to headlines. We remain disciplined and exploit their predictable responses. If you value systematic thinking over emotional noise, subscribe for frameworks that turn market psychology into systematic advantage. Download the complete Stoic exploiter methodology in the description, because understanding human nature is the ultimate edge.